Good morning, ladies and gentlemen. Welcome to the show. Today is Monday, June 24th, 2019. The Fed is boxed in. They're boxed into a trap. It's really bad. It's getting worse. And I'm going to talk about that after I go through the markets. So let's get started right now. Let's open up the charts right here and take a look at the markets. The first thing we're going to take a look at is silver price. Let me get rid of that pop-up ad. And now let me open the charts a little bit more. 15.34 bid, 15.44 ask. Silver's up 2 cents on the day. Gold and silver are starting to try to break away or break out. But we're fighting. Two things are happening at the same time. There's deflationary pressures because we're going into a recession. And also at the same time, there's inflationary pressures because the world central banks are getting ready to inflate. Okay, so we got both of those things happening at the same time. And this makes it very interesting, to say the least. Let's take a look at gold today. 1406 bid, 1407 ask. It's up $7.50 on the day. So gold's looking strong right now. Now let's take a quick look at cryptocurrencies. Now I'm going to refresh the page to see which way this is moving. It's staying up near $11,000. It's $10,890 right now. 10,862. So it's staying up near that price range of $11,000. We've had some big significant moves up in cryptocurrency quite recently, and now what it's doing is it's basically going along sideways again for a little while, Massive, the amount cryptocurrencies went up. I mean, this stuff not long ago was in the $3,000 range. That's $10,800. Let's take a look at cryptocurrency market capitalizations. 325.9 billion, 59.1% Bitcoin dominance. We see most of the altcoins are in the red right now. Going down the list, we see Bitcoin 10,843, Ethereum $309, XRP is 46 cents, Litecoin's 135.30, Bitcoin Cash is 470.54, EOS is $7.16. Binance Coin is $37.12. Bitcoin SV is $235. Tron is 3.9 cents. Cardano is 9.8 cents. Stellar is 12.7 cents. Monero is 115 bucks. This new Leo coin is $1.85. Dash is $175. And Cosmos is $6.66. And IOTA is 45 cents. That's going down. That's your top coins for today. Now let's take a look at the Dow Jones Industrial Average. 26,775. It's up 55 points on the day. See all this movement upwards? It's all based on one thing. They are pricing in Fed rate hike cuts down to zero. Right now, it's over 2%, so they're pricing in a whole bunch, not just one. The market has not just priced in one rate hike cut. What's moved this market up is pricing in all of the rate hike cuts, and also pricing in stopping quantitative tightening. This is what's been priced into this market already. It's already been priced in. This is this move. If we go over to the let's take a look at a 1 month chart. You see this move here? This move upwards over the last month? They've priced it all in already, knowing full well, the market knows full well a recession is coming, but it's went up instead of down. And the reason why is they've priced in what the Fed's going to do, or what they think the Fed is going to do. They priced it all in already. So there's only one place for the market to go, is down, because they've priced in all the good stuff already. Basically, they've ate the cake already. It's already gone. They've ate every last crumb, you know? So now let's take a look at the oil price today, and we see the oil price is moving downwards to the chagrin of OPEC, to the chagrin of the United States. It's moving downwards. They don't like to see oil prices going down, believe me. In this environment, I mean, I'll tell you what, oil is the lifeblood of the economy, is oil. Let's take a look now at U.S. Treasuries. And we see the yield curve inversion is still an ongoing issue, and it's getting worse today. We're seeing that the U.S. 10 years just barely keeping its head above 2%. So if we go down the list, we're looking at the U.S. 1 month at 2.14%, U.S. 3 month at 2.12%, U.S. 6 month at 2.05%, U.S. 1 year at 1.93%, U.S. 2 year. Look at the 2 year, 1.75. Look at the 3 year, 1.7. 5 years at 1.77, 7 years at 1.9, and the 10 years all the way down. It's almost ready to drop below 2%, 2.04%, and the U.S. 30 year is the last holdout at 2.56, but it's falling today too. So we got the long end of the yield curve today is all falling rates, which means the yield curve inversion is intensifying. Now let's take a look at the U.S. dollar index. And what we see here is 96.14. The dollar's rising a little bit right now, but it basically, if you take a look at the overall scheme of the day, if you go back here and look at the peak, 96.19, right? And this is rounding over. This is getting ready to start going down. Overall, over the day, we see a downward trend, even though, but that's just for one day. Let's just take a look here, and let's go into the 1 month, just to take a quick look. And you can see over a 1 month period, you can see where we started, basically right up here, and you can see where we're ending down here. So the trend of the dollar now is to drop off. And this has everything to do with what the Fed's been jawboning about. Basically, we're going to take a look at one more thing, and then I'm going to talk about the Fed some more, just before I finish the show. Deutsche Bank, 6.32. Deutsche Bank is dropping today, but it's not dropping very fast. We got to keep an eye on Deutsche Bank. Deutsche Bank could bring the entire system, basically, because of a whole bunch of other factors, not just Deutsche Bank alone, but it could bring the entire financial system into, basically, it could cause a lot of chaos. They got a big derivatives book, you know, and I know these derivatives cancel each other out to a certain degree, but even still, even it's so big, it's such a huge derivatives book that it would cause chaos in the derivatives market if Deutsche Bank goes down. So they're trying to keep Deutsche Bank going along. They're trying to keep Italy from going down too. I was looking at Italy today, and basically the ECB is kicking Italy down, kicking the can down the road one more time with Italy. They're basically, they're holding off all this whole stuff about they were going to fine Italy and everything. Well, no, they know that if they fine Italy, that what's going to happen is Italy will go down. So that was all just basically a ruse to try to get Italy to submit to the will of the ECB. That was just basically threats. But they know that they can't kick Italy when she's down, because Italy will collapse. And they can't afford that to actually happen, because Italy owes everybody a lot of money. They owe the ECB a lot of money. They owe France a lot of money. They owe everybody a lot of money. And if Italy goes down, then there's no chance of them ever getting that money back. And if that happens, then they're broke too. Basically, Italy could snap the whole Eurozone. And so they're going to keep kicking Italy down the road as long as they possibly can. But you know, they're going to run out of road in the end. But Italy's not what I really wanted to talk about this morning. What I really wanted to talk about is the Fed, how they've trapped themselves. Let me turn the charts off just for a minute, and I'm going to talk about this. The Fed has actually trapped themselves into a corner right now where they've done a lot of jawboning, they've done a lot of talking, and they have supported markets with this talking. But now at this point, talk isn't going to work anymore. The markets have already priced in all the talk that the Federal Reserve has done. And so they've already priced that in. So now even if they take the action of actually doing these things, it's already been priced in. The markets, the deflationary pressures right now from the world going into this recession that we're going into has a tendency to make the market roll over and fall. That's the tendency. But because of the Fed's talk, the markets went in the opposite direction, up. And in order for them to keep that market up, they're going to have to do more now than what they've just talked about doing, which the market's already priced in. They're going to have to go the extra step. They're going to have to invent new ways of supporting this market, which means basically cutting to the nitty-gritty of it all. What does that mean? It means that the Federal Reserve is going to have to print money. It's basically what we're getting down to. They're going to have to make a whole bunch more funny money to support the market. Otherwise, the market's going to roll over. But if the market rolls over, it's going to force them to produce much more funny money. Basically, what we're looking at is more economic stimulus. And they're going to have to find new ways of releasing this economic stimulus. The old ways that they did before during the economic crisis of quantitative easing and lowering interest rates, well, they've already promised this to the market basically right now, and the market has went up a little bit. But they've priced it in already, and now everything's going to come crumbling down unless they find new ways, more extravagant ways to release money into the system. Look to social programs. Look to infrastructure programs of infrastructure spending. Look to tax cuts. Look to the government to actually start to open up the floodgates of money. I call this the Great Print. This is what they're getting ready to do. But before that happens, because the Fed is behind the curve right now, they are substantially behind the curve. They should have already been cutting interest rates, which they haven't done anything. It's just talk so far. They should have already quit quantitative tightening, but they're still doing it, supposedly, I guess, until September. Now, at this point, they're going to have to take action, and soon. The market's going to roll over. The market's going to fall unless they actually take substantial action. It's going to require action now more than talk. Last Fed meeting, they've dropped the word patient. This is the only thing that's supporting the markets right now. It's that thin little hair of dropping the word patient, which means basically they're going to do a rate cut. Well, you know, if they try to get away next time with not doing this rate cut, the market's going to really roll over because they're expecting this rate cut. But what is the worst case scenario of all is they do all of these things and the market still starts to fall. That's why the Great Print is coming, because they are going to do all these things. They are going to start lowering interest rates. They are going to stop quantitative tightening. But it's not going to work because the market's already priced it in. The market's going to start to roll over anyway. Now, see, I'm looking out a few months from now. The market's going to start to roll over because we're going into this recession. This is when the Great Print is coming. And this Great Print is going to be magnificent for you people out there who hold silver and gold and cryptocurrencies. You've waited so long. Well, not so much for cryptocurrencies. Cryptocurrencies is already moving upwards. But gold and silver is just starting to... You see the first little signs of gold and silver starting to take off. And it's exciting. You guys have been holding it a long time. But I know what you're doing. You're sitting there right now and you're thinking to yourself, oh, it'll fall again. And maybe it will because there's deflationary pressures out there. But remember what's coming a few months down the line when the Fed really starts to go back into the money creation business because they're forced to support this market. They cannot afford to let this market roll over now at this point. They can't afford a 3,000 point drop in the market. It would start a process in place that could grow exponentially worse much faster. And then, I mean, printing money might just printing all the money in the world is just going to cause hyperinflation. So basically where we're going with this is the Federal Reserve and all of the central banks on earth are starting to lose their control over the world's economy. And in order to maintain that control, they're going to have to go into the greatest printing schemes you've ever seen in your life. Do not be surprised what they pull out of the bag to try to stop this that's coming. And do not be surprised at all at how much pressure they put behind gold, silver, and cryptocurrencies to move upwards in price when this time comes. And this is what we've been waiting for. Is a change in monetary policy by the Federal Reserve and the other central banks. If you're a holder of gold, silver, or cryptocurrencies. You know? I mean, we suffered through an awful long, bad cryptocurrency market. You know, and the same thing with gold and silver. Cryptocurrency's taken off first, but gold and silver's not far behind. Listen, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.